Hello everyone, welcome back to my channel Decode Strategies, your one-stop destination for analyzing and evaluating various strategies. In the last video, we analyzed or evaluated the SIP plus lump sum approach, wherein we added one moving average indicator which will tell us when to do the lump sum investment. We've seen the rules and respective returns that were made over a period of 10 years. We've also compared the returns of SIP plus lump sum approach with SIP only approach. This video is continuation or extension to the part 2 of Nifty Bees series, and if you haven't watched part 2, I would strongly recommend you to watch it first before you watch this video. Please click either on the I button appearing at the top, or for your comfort, I've added the link in the description. Alright, so without wasting any time, let's get started. Okay, as mentioned earlier, in this video, we are going to convert the step-up SIP approach into step-up SIP plus lump sum approach. In this, along with the step-up SIP, we will be putting the lump sum amounts in chunks over a period of time. To do this, we are going to take help of one moving average indicator, which will tell us when to do a lump sum investment. Here, first I will explain how to set up this indicator on the chart, and then we will see the rules, that is where and when exactly we need to do a lump sum investment. Finally, we will see how different are the returns when compared with the step-up SIP approach. Without further delay, let's open the chart and start our analysis. Before we begin, if you are someone who has watched my earlier video and is aware of how to open the chart and add the moving average indicator, feel free to skip these instructions that I am going to share now, and you can directly go to the scenario section of this video. Right now, I am in the trading view, and this is where I'll be opening the chart and will add the necessary indicator. For someone who is unaware of TradingView, this site allows us to perform some basic analysis of various stocks and ETFs for free. All you need to do is just sign up and you will be able to open the charts and add up to 3 indicators. But if you want to access the advanced features, then you will need to get the paid version. Since I am comfortable with TradingView, I'll be doing my analysis on this, but feel free to do the same thing in platform specific charts. Let's add Nifty Bees ETF to the watch list. For this, navigate to the watch list section and click on the plus icon. Search for Nifty Bees and select this option. Now click on Nifty Bees ETF and then click on the Nifty Bees chart. So this will open the chart of Nifty Bees ETF. Right now, we could see we have daily, weekly, and monthly time frames. By default, the daily time frame is selected. Let's change it to monthly. For our analysis, we will be using SMA or the simple moving average indicator. To add this indicator, click on indicators, search for moving average, and select the moving average simple option. Close the window. By default, SMA with a length of 9 gets added. Click on the settings icon, change the length from 9 to 25. Click on OK. Now, pause the video and take a closer look at the chart and see if you could find any pattern. Alright, here are my observations. As you noticed, a very few times the price or the candlestick has closed below this moving average price. Coming to the second observation, you might have noticed that for a good number of times, the price has either went below or just touched the moving average, and then the price went up and the candlestick has closed above the moving average indicator. So this is called taking support on the moving average indicator. Here, I have clearly differentiated both my observations, that is, closing below the moving average price and taking support on the moving average price. Please do notice that not every year has this phenomena of the price taking support or closing below the moving average. If in a given year the price doesn't take support or doesn't close below the moving average, then we will just do the SIP and we will not put any lump sum investment. So to summarize, the idea here is to continue our SIP on last trading day of every month, but for lump sum, we will wait for the right time. Now a question may arise like how will I be able to buy when the price is taking support on moving average? For this, You need to spend 1 to 2 minutes of your time every day. That is, as soon as the market starts at 9:15 a.m. every day, look at the moving average price and place a limit order for the lump sum investment. Do not put the exact price of the moving average. Instead, increase the moving average price by zero point 0.5 or 1 rupee and then place the order. For example, if the moving average price on a given day is 225, then you place the limit order for either 225.5 or 226. This is because sometimes the share price comes very close to the moving average price, and instead of touching or going below the moving average indicator, it starts going up, and we may miss our lump sum opportunity here. Scenario 1. Current price is well above the moving average indicator on last day of the month. The action that you are going to take is just do the step up SIP alone. Scenario 2. Current price or candlestick has closed below the moving average indicator on last day of the month. The action that you are going to take is to combine your current year step up SIP amount and lump sum amount and then place the order. That is, let's say your current year step up SIP amount is 3000 and lump sum amount is 9000. Then on the last day of the month, we will invest a total amount of 12,000 rupees. Similarly, if your current year step up SIP amount is 3,300 and lump sum amount is 9,900, then on the last day of the month, we will invest a total amount of 13,200 rupees. Scenario 3. Current price just touched or took support on the moving average indicator on a particular day of a month. The action that you are going to take is to invest the lump sum amount on the day the price has touched or took support on the moving average indicator. And as usual, you will be doing the step up SIP on last day of that month. Let's now discuss the most important part of the strategy. What should be the lump sum amount? For my analysis, I have used the step up SIP to lump sum ratio as 1:3. That is, if my first year step up SIP is 3000 per month, then my lump sum amount will be 3 into 3000, that is 9000. Similarly, considering the step up of 10%, if my second year step up SIP amount is 3300 per month, then my lump sum amount will be 3 into 3300, that is 9900. Let's check out the returns. I'll show you how it would have worked if we have started using this strategy from different years in the past. Let's quickly compare these returns with the returns of step up SIP only approach. As we can see, combining step up SIP with lump sum investments has given better returns. Alright, we are wrapping up this video, and in the next one, we'll deep dive into the Gold Bees ETF, which is one of the most trending ETFs. We'll break down the buy on monthly close strategy, and we'll be covering various approaches. Until then, happy investing everyone.